This morning, we are joined by Alex Doma, who's a partner of assurance and accounting at the firm, and Vinay Khosla, who is a tax partner at the firm. And Vinay will get us started this morning.
Good morning, everyone. So some of you may be wondering, given the topic posted that it's a presentation regarding ASPE and preferred shares, what am I doing here? I'm a partner in the tax group. I have little to do with the assurance function. But this morning's topic is a rare intersection between the worlds of tax and accounting. So Alex will be speaking to you in some detail regarding the whole notion of preference shares and the accounting implications of those preference shares. And the implications of those preference shares on some of your clients and what they may be facing when they're showing you financial statements that you may have never seen before. And some of your knee-jerk reaction may very well be, these preference shares gotta go. Talk to your lawyer about making them back common shares. Is there something you can do, Mr. Client, to clean up your balance sheet and get these preference shares off the books? It's causing trouble, perhaps on debt covenant ratios, etc. And the client will be scratching their head going, I don't get it. My numbers are what they were last year. The business is as healthy as ever. Everything's looking okay. What are you talking about? We paid Bateman MacKay some good money and the lawyers to implement this structure that involves the existence of these preference shares, and it's consistent with our estate planning and asset protection objectives. So why is it causing trouble today? So to help you better appreciate where your clients are coming from, let's get into the evolution of what happens within a business, a successful business, and why these preference shares come about, especially a business that's well advised, that's receiving proactive tax advice that I feel myself and our tax team do a pretty good job giving to our clients. Next slide, please. So most businesses, once they evolve from, let's say, a sole practitioner, unincorporated format, they are incorporated, business continues, the OpCo is successful, and over time, OpCo generates retained earnings of, call it, $1 million. Now, a somewhat proactive accountant will look at this situation and say, okay, your operating company has $1 million of retained earnings in it. Some of it may be necessary to continue the business, like inventory, accounts receivable, work in progress, that kind of thing. Some of it may be redundant, just extra cash, maybe GICs, or other marketable securities, just not necessary for the core business. So if OpCo is sued by a known or unknown creditor or plaintiff, those retained earnings are in harm's way, irrespective of the nature of the lawsuit, whether it's product liability, a slip and fall, who knows what happens. And businesses, sure, they have insurance, but sometimes insurance policies don't always cover certain risks, or maybe certain exclusionary clauses have been fallen into by accident by the operating company. So a prudent accountant will often recommend the following structure. Next slide, please. Which involves interposing a holding company between Mr. X and OpCo. This is what I call the accountant's knee-jerk reaction to this issue of having retained earnings in OpCo. So the series of transactions is relatively simple. Mr. X, on a tax-deferred basis, rolls down his operating company to a newly formed holding company with no other business activities. And then subsequent to the roll down, the tax-deferred rollover of OpCo to HoldCo, whereby instead of Mr. X owning 100% of the share capital of OpCo, this HoldCo owns 100% of the share capital of OpCo. Immediately thereafter, OpCo will pay up a dividend equal to retained earnings of $1 million. And to the extent the OpCo requires capital in the business to run the business, there'll be an intercompany loan by the holding company back to the OpCo. That loan will be secured by usually a GSA or a PPSA, and it's typically behind the bank, who always retains first position. Usually that involves a bit of communication between the accounting firm and the bank to advise them what's transpired, and a postponement is usually signed off on and sought. In the event that, so to give you an example of what that would look like, let's say OpCo had $800,000 of WIP and accounts receivable and inventory and other working capital items, and $200,000 of cash. In that scenario, the dividend would be $1 million still. The intercompany loan back to OpCo, because OpCo needs that working capital to sustain itself. So the $800,000 would be a dividend in kind, and $200,000 would be redundant cash, and the intercompany loan would be $800,000, while HoldCo would retain $200,000 in it. So that this structure accomplishes the very basic objective of asset protection. However, in our experience, this kind of structure makes exit planning very challenging. And what I mean by challenging is it's very difficult to accomplish a tax effective exit of OpCo. To be more specific, I'm referring to the potential and likely loss of capital gains exemption by Mr. X and potentially other shareholders, inclusive of Mr. X's family, for example. So many of you may have heard of the capital gains exemption. And that's a rare gift in the Income Tax Act. That enables a business owner to sell the shares of his or her business and receive up to currently approximately $900,000 of capital gains without the incidence of taxation. And the whole legislative intent is to help business owners who have borne a lot of risk over the course of their business activities to retire tax effectively. Many of these business owners don't have much of an RSP. They've been putting all their money back into the business. So it sounds like a great opportunity for a business, but business owner, I mean. However, this classic holdco structure completely can frustrate that capital gains exemption. And I'll explain what I mean by that. Let's kick the tire 10 years in the future, where Mr. X now is ready to sell his business. Purchaser comes along and says, okay, I want to buy your business, Mr. X. I don't want the $2 million in GICs, marketable securities, or real estate, or whatever else your holding company has amassed over the last 10 years. I just want the shares of your OpCo. So Mr. X is no longer in the share purchase agreement the vendor of OpCo. It's the holdco. And guess what? The holdco is not entitled to the capital gains exemption. The capital gains exemption, that tax-free gift to the business owner, is only available to individuals. There's no concept of a corporate capital gains exemption where holdco sells OpCo. It's only available when Mr. X sells OpCo. So although this structure creates temporary relief from potential creditors, it causes significant future long-term issues, which leads us to the next corporate structure, which, next slide, please, which accomplishes a bit of both. Now, this structure may look similar, but it's different in the sense that we form a sister company rather than a holding company. This is a more sophisticated version of what I call standard creditor proofing. So we form a sister company. It's a bit more complicated. Mr. X does a share-for-share exchange. So subsequent to the share-for-share exchange, Mr. X has both commons and preference shares of OpCo. Mr. X rolls over the preference shares of OpCo to sister co, and those preference shares are redeemed, or sometimes they're not and they remain outstanding, but dividends are paid on the preference shares to sister co. And those dividends can be received by sister co on a tax deferred basis. Now, fast forward, so over time, so it'd be very similar to the holdco scenario, except you're redeeming out or paying a dividend equal to the retained earnings to a sister company. And those preferred shares are often redeemed out, maybe not right away, maybe in a few years. But in that scenario, you've got the same situation where the retained earnings of the OpCo are transferred on a tax-deferred basis to Sysco, reducing the OpCo retained earnings from, if we use the same numbers as the prior slide, from $1 million to nil, and the retained earnings will go to Sysco, the sister company. So Sysco will have $1 million of retained earnings in it. And again, Sysco has no other activity. It has no other exposure to potential plaintiffs. It's inactive, and Sysco can take the redundant assets as they build up over time and invest in stocks, bonds, mutual funds, real estate, etc. Now, when it comes time to selling OpCo, assuming the preference shares are redeemed at the time of the sale, or they can be redeemed shortly prior to the sale, provided OpCo has sufficient retained earnings. Mr. X is now in a situation where he can directly sell his shares of OpCo to the purchaser. So the main difference between this structure and the last structure is you achieve the asset protection. However, on exit, the vendor of OpCo is Mr. X, who receives a capital gains exemption, as opposed to HoldCo, which has no capital gains exemption. Only individuals can get their capital gains exemption. So it seems like this structure is a no-brainer. However, it's a fair bit more complicated than the prior structure, and many non-tax specialist accountants are not overly familiar with this type of reorganization. It may not be in their practice bandwidth. Who knows? But it's also more complicated and more expensive, because every year you want to do asset protection, i.e. move retained earnings from OpCo to Sysco. You have to do this complicated share for share exchange and roll down to Sysco, pay a dividend across, maybe a redemption thereafter. It's complicated. And what could easily happen is, you know, business owners may not want to pay to have this done or put their time and attention to have this done every year. So OpCo to some extent may be exposed, depending on the frequency by which they do this kind of corporate dividend planning. To contrast, the creditor proof, the HoldCo structure is much simpler to implement and maintain. Every year, you're just having the lawyer as part of the regular minute book update, flip up a dividend from OpCo to HoldCo, and then repeat. Not another share for share exchange, you know, not another rollover. And rollovers have to be filed whenever you do them with CRA. So arguably the sister company solution, if you're going to be doing all these rollovers year in, year out, or biannually, or however often they're done, arguably perhaps your audit risk increases. Because again, the more paper CRA has to look at, you have increased risk of CRA scrutiny and related audit. So again, interesting conundrum businesses get into, which option to select. So, which brings me to our next corporate structure. Now, just a quick note again, another contrast between the sister company structure and the HoldCo structure is the sister company structure suddenly introduces the whole notion of preference shares, which will be a perfect segue into Alex's discussion on ASPE and the ASPE implications of preference shares. Now, this structure has preference shares as well, and perhaps on a more permanent long-term basis, depending on how much those preference shares are worth and how long we expect them to be issued and outstanding. So purely from a tax planning perspective, for successful business owners, this can be an outstanding structure for those businesses. Because not only does it accomplish creditor proofing, whereby also known as asset protection, whereby dividends can flow from OpCo to this. In this case, it's not a HoldCo. I've labeled it as NewCo. So it accomplishes creditor proofing / asset protection. There's also some outstanding succession exit planning features of this structure, in addition to estate planning, should something happen to Mr. X. So this structure is commonly referred to as an estate freeze with a corporate beneficiary of a trust. So let's get into the high-level mechanics of this structure. So OpCo is successful. There's significant retained earnings in OpCo. Over and above retained earnings, it's worth something. It's worth whatever. It's $10 million, and it's expected to continue to increase in value over time. It's going to be a growth story, or continue to be a growth story. So, from an estate planning perspective, I always ask my clients, on death, would you rather, if your business is worth $1 million today and it's going to be worth $10 million in the future, would you rather have your estate write CRA a check for $250,000 or $2.5 million? Most prudent clients will say the former, $250,000. In which case, this structure makes a ton of sense. So let's go with that example. Let's say today OpCo is worth $1 million and it's expected to be worth $10 million in the future. So the first step of the transaction is Mr. X will exchange all of his previously held common shares for frozen preferred shares that are redeemable and retractable for $1 million. Say he has 1 million preferred shares, redeemable, retractable for $1 each. Then from a pure business valuation perspective, by the way, we actually more than highly recommend, we insist on chartered business valuators to get involved, to tell us and confirm with us the value of OpCo, so we can properly justify to CRA, if they look at our reorganization, that Mr. X's frozen preference shares are indeed worth $1 million. So at that stage, Mr. X, since we've assumed OpCo to have a value of $1 million, he has all the value of OpCo in his frozen preferred shares. So I'm not sure if many of you are aware of how capital markets work, but if you look up, let's say you compare a big bank preference share to its common share. So preference shares typically do not fluctuate in value. They have a face value, and the only reason they'll fluctuate at all is when interest rates change. But otherwise, they stay stable under the assumption that the issuing corporation, like any big bank, for example, or BCE or TELUS, is going to be there to have the funds to redeem the preference shares, which hold priority over common shares on liquidation, dissolution, or winding up. Okay, so the family trust at this point, which will be a newly formed entity, which is a legal relationship. A trust is not as formal as an entity as a corporation. It's a legal relationship between a settlor and beneficiaries to hold and manage the property on behalf of the beneficiaries. That's the role of the trustees. And the trustees have a fiduciary responsibility to the beneficiaries. So the typical family trust that we form to keep a fair degree of control with the family is the trustees of the family trust will be Mr. and Mrs. X, sometimes an arm's length third party as a contingency should something happen to Mr. and or Mrs. X. And the Benny's beneficiaries of the trust will be the family of Mr. and Mrs. X. And then this corporation that would be controlled by Mr. X, being NewCo. So once this structure is put in place, OpCo can pay that $1 million dividend to the trust, and the trust can allocate that $1 million dividend to NewCo on a tax-deferred basis. And similar to the HoldCo scenario, or even the sister company scenario, if OpCo needs $200,000, or sorry, it'll need the $800,000 of working capital, NewCo can make that related party loan to OpCo and secure that $800,000 loan from NewCo to OpCo. And $200,000 can continue to be held by NewCo in the form of investment assets. So let's now fast forward 10 years, where the dream of Mr. X and his family have been realized. The company is now worth $10 million. Mr. X's shares are worth $1 million. The common shares held by the family trust are worth $9 million. So big purchaser comes along. Okay, we're going to pay you $10 million for OpCo. If you look at the share purchase, the anticipated share purchase agreement, the vendors of OpCo will include Mr. X and the family trust. Mr. X will receive $1 million of the proceeds, of which approximately $900,000 will be received without incidence of taxation on account of that capital gains exemption that I spoke to you about earlier. And the remaining $9 million will be received by the family trust. From a tax perspective, the trust can allocate that $9 million amongst the family members. Now, let's say Mr. X has a very large family. You might have brothers in there, you might have nieces, nephews, and you know, who knows, grandchildren. My record is actually close to 20 family members, whereby we had two brothers and their families in their respective family trusts owning shares of an OpCo. So circling back to the example on hand, so let's say Mr. X has, other than himself, because he's already used his capital gains exemption on the sale of his preference shares, if there's 9 other family members as beneficiaries of the trust, in theory, the family trust can allocate up to $9 million of capital gains up to those particular family members. And to the extent each one of those individuals have not utilized his or her capital gains exemption, you could have a $9 million capital gain with little to no incidence of taxation. Or in this example, $10 million of capital gains with little to no incidence of taxation. That planning is completely foregone and unavailable in the HoldCo scenario. It's still potentially available in the sister company example, but again, there's only one capital gains exemption on the table in the sister company example, while this one particular example in this particular structure unleashes a whole realm of tax planning possibilities. But note these frozen preferred shares again that Mr. X continues to own. The only way to get rid of those frozen preference shares in this particular structure is by slowly but surely redeeming them out, okay, for fair market value. So if you ask those frozen preference shares to be redeemed out, it has to be done with proper tax advice, because in this structure, if we just purchase those shares for cancellation or redeem them out, those frozen preference shares, Mr. X will have a deemed dividend of about $1 million in this example. And the tax liability on that could be as high as $470,000. So that would cause significant strain on many businesses, especially when they don't have the cash to show for it. It's almost like tax on air, and it's to be avoided at all costs. Now, there may be workarounds to redeem those frozen preference shares on a tax deferred basis, and it could involve, blending a holdco structure into this structure for future dividend redemptions. I mean, preference share redemptions. But again, once the structure is in place, those it's a bit challenging to I guess simply do away with these frozen preference shares. However, they exist for a reason, and they're an important part of the tax planning affairs of our clients. I'll now turn it over to Alex to talk about the accounting implications of these frozen preference shares.
Thank you, Vinay. Thank you, everyone, for attending quite a technical session here on the tax plan that Vinay spoke about, and then what I'll be speaking about here. Vinay did a good job going through those different corporate structures, and those are fantastic options for your business owners, especially ones that are, like you said, outgrowing their current accountant, or not getting the advice necessary, and their business is growing and continuing to grow. Some of those transactions are things you want to do sooner than later, especially with the contemporary structure that he spoke about there, which is more or less the penultimate structure that you could advise on. So thank you once again for attending. So today we're going to be talking about retractable or mandatorily redeemable shares issued in a tax planning arrangement. So as Vinay alluded to, those preferred shares. So background on that, technically speaking, let's call them ROMRS, they do meet the definition of a liability in accordance with the handbook. And just a reminder, everyone, these standards apply to review engagements and audits. You will not see this in your notice to reader financial statements. So again, ROMRS do meet the definition of what should technically be presented as a liability, but back in 2011, they provided a carve-out exception for redeemable preferred shares issued under specific sections of the Act. So that is why you'll see them under the equity section for nominal or par value on the financial statements, with some added disclosures of what the redemption amount is. So why the changes? I have 3 points here, but I think there's 4. The accounting ASPE stands for the Accounting Standards Board. They had some concerns with accounting treatments and people applying accounting sections that are not in accordance with what the intention was. So that's the first one, that liability accounting was being applied to transactions that don't fall under this. This was only permitted equity accounting for ROMRS issued under specific sections of the Income Tax Act, but not all. And lastly, excuse me, it was required where ROMRS classified as equity be reclassified as liabilities when redemption is demanded. And that was a little bit loosey-goosey on the interpretation by a variety of accountants. And then fourth, kind of always laugh about the Accounting Standards Board makes these changes just to keep themselves employed. Make sure that we always have to stay up to date on a variety of sections and keep moving the needle. So what are ROMRS issued in a tax planning arrangement? So Vinay did a very good explanation of where they would come up. So specific to this section, the holders of the shares have the right to require their redemption on demand and at the redemption price equal to fair market value. So when Vinay was alluding to the shares were exchanged for fair market value, and we do use valuation CBV specialists, that's what that's alluding to. And they have the option to turn around and tell the corporation to pay them right away. The shares have at least voting rights on any matter involving a modification to the attributes. So the company can't just go change them without the individual knowing. There are no restrictions on the transfer. The shares have priority on distribution and liquidation over any type of shares. And that's usually the case with preferred shares. Should something happen, they're always paid out first, and common shareholders following that. And then lastly, and the most important one, is that they were issued as part of a tax planning arrangement in one of the variety of ways that Vinay alluded to there. They weren't just a preferred share equity raise per se, because then it would be shown as a liability and not meet the carve out. So when can ROMRS issued in a tax planning arrangement be classified as equity? So in order to continue the treatment as how we have them for all of our ROMRS that are issued in a tax planning arrangement on our financial statements, there are three items, three qualifications, and all three must be met in order to continue to show them. So the shareholder receiving the ROMRS retains control of the enterprise. So a good example there was when there was say a shareholder owns 70% of the company with their partner owning 30. The individual with 70 does an exchange for the same voting control rights for the 70, so they retain control. We can show those ROMRS as equity as opposed to liability. There's no consideration other than the shares. So in this example, is like Vinay alluded to, where it is just a share for share exchange, exchanging common shares for preferred shares. And there's no cash or other assets involved in the transaction. And lastly, there is no redemption arrangement. So as Vinay had alluded to there in his example, the preferred shares of 900,000 in that example, there was no mandatory repayment schedule of those shares. Sometimes we do see that when, say, parents sell to their kids, that is part of their retirement plan and they want to redeem 50,000 per year. So that would put this offside, and the ROMRS would have to be issued as a liability or classified as a liability. So again, all three of these must be met in order to classify ROMRS as equity as opposed to a financial liability. So again, if these were initially classified as equity, but one of those three became offside in a year, the classification would have to change from equity to a liability. So it initially, again, might meet all the conditions, but if it gets put offside, and there is no mandatory year after year analysis that needs to be done. However, the accountant should be aware of situations that arise that would put it offside, therefore making the classification mandatory from equity to liability. So some examples of a future event or transaction are below here: the death of the holder, change in ownership of the enterprise, maybe they've lost control now, a change in the shareholders agreement, because control, again, doesn't always mean the number of shares. The shareholder agreement can alter depending on number of shares, who's a director on the board, etc. So again, redemption of some or all of shares, maybe some of those redemptions that occurred inconsistently actually made the ROMRS shareholder no longer have control, and the new shareholders do have control. The creation of written or oral arrangements that gives holders of the ROMRS the right to redeem with a fixed or determinable period. This one will be a tricky one if it is an oral arrangement. So as accountants, we have to continue to ask and inquire about if any sort of arrangement has been made subsequent to the tax reorganization, or again, any modifications to the shares. So one other thing to mention is that even if it does meet these three qualifications, the company, with the help of their accounting, can still classify the ROMRS as a liability. There may be a variety of reasons why they would want to do so. One of which that they bring up is just the cost to do this analysis all the time, year after year after year, which again, I don't believe to be sizable cost, but it's, I guess, the easy way out. In saying that, once it is classified as a liability, you cannot switch it back to equity, even though it meets the definitions and the qualifications. So this is just an easy, straightforward example of how it's going to look after the fact. So company A issues the ROMRS in a tax planning arrangement in exchange for common shares, like a transaction that Vinay had mentioned there. And it's recorded at the company A's financial statements at $500,000. The redemption amount of the ROMRS is $1.5 million. The ROMRS do not meet the classification conditions to be classified as equity. Therefore, they will be classified as a financial liability. So you can see here that the other side of the entry, so your liability will be credited and increased significantly by $1.5 million, and your retained earnings or another account within retained earnings will be debited for the $1 million, and then the common shares, which were exchanged for the prefs, will also be debited for $500,000. Thus, you can see that the balance sheet now has a large current, actually, liability of $1.5 million that, if these were issued this past year, didn't exist. So you can see how that's a bit of a concern from the banking arrangement side in the agreements there that would definitely put covenants offside. So again, the major impact here, the amendments to section 3856 will result in some redeemable pref shares being classified as a financial liability. This will definitely affect financial metrics such as debt to equity ratios, interest coverage ratios, as the debt covenants and in banking arrangements, and sometimes shareholder and other supplier arrangements can put them grossly offside. So again, that's why we're having this conversation, this presentation. And I do look to the audience here as a bunch of bankers to have some insights into how the banks will be dealing with it. We know that in a variety of arrangements or banking agreements, you can't pay dividends unless requested. However, that's all great, but when you've got $1.5 million of pref shares that are now as a current liability, are we going to have carve-outs for ROMRS? Because this was never stated in the agreements of prior. And as you guys know, if we are offside on a debt covenant, all debt would have to be pushed to current, unless we got a waiver of demand from the bank. So it's just increasing, again, compliance from our side, a little bit of increased communication with bankers, which is never a bad thing. But it might be some increased work on your side as well as to why accountants will be asking these particular questions. And again, this is a general FYI for our banking relationships to say you should be expecting now some financial statements with significant debt balances and current debt balances. If there is a redemption schedule, some of that debt could be current, some of that debt could be long-term. If there is an oral or written agreement to say that maybe they're redeeming $50,000 per year, So 50,000 will be current, with the remaining 1.45 in that example being long-term. So again, maybe not as big of an impact, but it still may exist if there's no repayment schedule. So that's it. If there's any questions, concerns, and I'd actually like to hear from everybody, or whoever's willing to offer it up, if your specific bank has made any amendments to banking agreements. Can we expect to see amendments to banking agreements, or will it be on a case-by-case basis? Will there be waivers? Again, open the floor to that. Thank you.
So just a quick reminder, there is the Q&A section at the bottom, and then you can also raise your hand, and I can give you permission to speak as an attendee. So if anyone wants to contribute anything on that side, just either click the Q&A or raise hand button, and we can get the conversation going. Thanks to both Alex and Vinay for walking us through that session, and thanks to everybody who was able to attend this dense and technical session on this rainy Thursday morning.
So Alex, just to conclude upon, to further illustrate the implications on the balance sheet. So let's say, you know, a tax accountant, without consulting with his assurance partner, does a share for share, does an estate freeze, right? And usually in an estate freeze, the equity, the common shares are carried at like $100, right, on the balance sheet. So we exchange $100, like the company's obviously worth more. So we exchange common shares at cost for $100, and Mr. X receives in exchange for his common shares preference shares worth $5 million. Okay, that are somehow meet the definition of being a ROMR. So basically, what the implication of this, and correct me if I'm wrong, all of a sudden we've literally nuked the client's balance sheet. Like, you've got a $5 million liability, like out of thin air. There's no cash that they received on the other side or anything to help support that liability. And valuations are hitting, like with equity markets where they're at. You know, when you read the business valuation reports, because you know, it boosts the multiples that are being applied to small businesses. Mm-hmm. It's like roll down effect. So we're seeing big valuations come out of our clients. So is that a fair a synopsis of the?
Yeah, that's exactly it. So if it didn't meet one of those three definitions or conditions, then yes, and to boot, that if there is no written or oral agreement to repay that $5 million, that's all going to show up as a current liability. So a majority of banking arrangements, banking agreements call for a debt service coverage ratio of sorts, right? Which is based on current liabilities. So that's why we ask, are these going to be carved out? Will there be amendments to a banking agreements? Will there be specific amendments just for this, for ROMRS? So it is, as you can see, a trickle down effect now from accounting into banking, more so, and some of this was because the Accounting Standards Board went to market, went to stakeholders, and some stakeholders said that by treating it as equity, they don't have an accurate picture of the potential liabilities of the company, right? As you know, a preferred shareholder, albeit might not make sense from a tax point of view, as Vinay alluded to redeem $1 million worth of shares in 1 year, they still do have the right to, right? And by having that just buried away in the equity section or one of the notes, somebody might not see that right away. So again, to use Vinay's term, yes, it could nuke the balance sheet of sorts, and put companies immediately offside, which always throws everybody into a bit of a tizzy.
So when are these rules in effect, Alex?
So they actually were supposed to come into effect January 1st, 2020, but COVID, another victim of COVID, pushed it back a year. So now all financial statements January 1st, 2021, on a go-forward basis, will be impacted by this.
Mm-hmm.
So year ends that should be getting shortly for December 31st.
December's, yeah. So this is a real current and hot issue.
Mm-hmm. Yes.
Mm-hmm. Mm-hmm. And maybe for the benefit of the attendees, what's the difference between an LPA, which you have, and I don't?
So an LPA is just a licensed public accountant, which means that I've put in enough time, hours, blood, sweat, tears into assurance engagements. So for those of you out there, we actually have 3 LPAs on our staff, meaning that individually each of us could sign off on a set of review engagements and audited financial statements. So again, Vinay alluded to, our tax team is very strong with multiple staff looking at reorganization. Our assurance team is tremendously strong on that side as well and very well qualified.
Mm-hmm.
And the LPA is something that has to be renewed every single year. So you need to put in enough hours each year to maintain.
Right. Being a tax specialist, I think I lost my LPA, I don't know, maybe 99. No, maybe 2000, but not much beyond that.
Okay, and with that, I think we'll wrap it up for the day. Thanks everybody for attending, and thanks again to Alex and Vinay for walking us through that session. You can see their contact information there on the screen, so please feel free to reach out with any questions or comments or any accounting or tax things you'd like to discuss. Thanks again, and have a great day, everybody.